Good afternoon, ladies and gentlemen, and thank you and to AIRMIC for giving us the opportunity to share some of our thinking with you about how you as risk managers can all raise the profile and importance of insurance within your organisation. I'm Hamish Roberts and I lead JLT business development activities, and along with my colleague Adrian Donald, we're going to give you a brief overview of the project and its output and how it has been summarised in our mini report. This report was handed out at the AIRMIC conference about a month ago, and copies are available from both JLT and AIRMIC and online. I've been in insurance for around 32 years. I've been a broker and an account exec, and now I'm helping with business development.
Hello, my name's Adrian Donald. I've been at JLT for over 2 years, and I'm a partner in the specialty property casualty division. I spent 34 years in the insurance industry as a broker, working for major clients on complex global programs, and also as an insurance manager for a major multinational consumer goods company.
In short, we all need to translate the benefits of what we all do into corporate speak. Towards the end of last year, we began to talk to AIRMIC to share our views and some of the work we were doing with our clients. We were finding that the risk manager within an organisation was often using some basic measures to summarise the benefit of the programmes he or she was arranging on behalf of their company. We saw that risk managers often summarise their efforts by talking about rate reductions, premium reductions, or coverage exclusions, and whilst these are all great achievements, they have two major drawbacks. The board doesn't talk about premium or rate reduction or coverage, and what happens when these things stop. We believe that a risk manager should think about how to translate their achievements in the market into a language that the board uses to summarise the value of insurance. Working with AIRMIC and interviewing members via their longitude survey in the spring, we found that a number of members had similar observations. Our premise is that if you, as a risk manager, get this right, you'll be able to articulate the effect and impact that insurance has on your major corporate measures, and accordingly the role of risk manager will be recognised as a valuable contributor to the strategic goals of your company.
Looking at the key findings from AIRMIC's survey, there are 3 points that I would like to highlight. Firstly, that although 40% of respondents believe that insurance is becoming a more regular boardroom agenda item, the majority of respondents do not think that the perceived value of insurance will increase in the next 3 years. Secondly, 39% of respondents believe it is difficult to demonstrate how insurance is valuable in helping their company achieve its corporate goals. And lastly, that 47% of respondents find it difficult to explain the value of insurance and risk management activity. These findings suggest that a more dynamic discussion is needed, and as part of this webinar, we're going to outline how this can be achieved.
So how might this conversation go? So who are the stakeholders? This diagram summarises all the key conversations, and we start with the OpCo, the end business user. A risk manager will often dictate and articulate the coverage, the premium allocation, the retentions, deductibles, any gaps in cover, any claims activity, and also with strategic risk mitigation help in their conversations with the business user. With the broker, a risk manager will need to talk about transparency. We'll talk about service expectations and KPI and deliverables. We'll need to know about the state of market. Wants to know about emerging trends and emerging risks, and also ultimately the transaction. With the market, it's important for risk managers to have relationships with insurers to make sure that their submission is well received in the market. Insurers have a duty to serve a client as well, to make sure that claims and additions and deletions are all looked after. Again, conversations about coverage, how it's priced, what's fair, what's applicable, and what's achievable. And ultimately, the bit why we all buy insurance is for claims, to make sure that claims are serviced and looked after clearly, and to form key relationships with the main insurers. Then with joint venture partners, many organisations have JV partners where the risk manager is responsible for both the whole project's insurances. Again, to explain the coverage requirements, to negotiate premium allocation, although that will probably be done on a pro rata basis of ownership, to look at retentions, responsibilities and activity around servicing such policies, and again claims. With the executive, and they're talking about compliance and legal and treasury, to talk about audit, tax, and even captive retention and regulation. But with the board, and this is perhaps the most important part of this finding, with the board we normally talk about premiums, retentions, sometimes total cost of risk, which is the addition of deductibles and premiums, difficult claims and uninsured risks. But in short, we have a conflicting message. We don't talk about what the board talks about. We talk about limits, deductibles, coverage and clauses, gaps, premiums and rates, whereas our board talks about cash, debt, credit, margin, share price, dividend, and other language that is a conflicting message. So how might this conversation go differently?
So how can you have a better discussion with the key stakeholders within your organisation about how insurance is adding value? Let's start with what typically happens today. What you see here is a common programme structure that is often used to illustrate the insurance arrangements. We all know that there are months of work invested in planning, structuring, negotiating and implementing and administering these programmes. But when it comes to engaging the board and the CFO, the primary focus is generally on key components, which typically include limits, coverage, deductibles, and premium. These are all important criteria from a technical insurance perspective and are what we, collectively, are expected to manage as efficiently as we can. But for the board and a CFO, it's very hard to align these criteria with the key financial performance metrics that they are focused on delivering for their stakeholders, and particularly the investors in the company. So how does the board view these financial metrics, and where does insurance fit? Well, most boards and the CFOs will look at the business in terms of revenue, the opportunities to grow the business as well as the threats that could impact this revenue. They'll also look at costs, controlling costs to maximise profitability and deciding where to invest in the business to achieve the best growth and return. And margin, the profit that the business is able to generate. Insurance, when presented in the traditional way that we discussed earlier, is generally seen as a cost item and is not measured in terms of its value in protecting the margin. The challenge then is to find a way of relating insurance to the benefits or value it delivers in reducing potential volatility of the key financial criteria that matter to the board. So how can this be done? How do we translate this into board speak? Let's look again at the revenue and cost cube, but this time start to identify the financial criteria that matters to a company. Each company will have its own key metrics, and we need to understand what these are. This is a key step, and it will require the involvement of stakeholders within the business, typically in finance and treasury, but often in other functional and operational areas, such as tax, legal, risk management, and business unit leaders. We often see that companies will have objectives and shareholder expectations regarding metrics such as earnings per share, typically in terms of how much the dividend will grow, or share buybacks, a way for the company to grow shareholder value by reducing the number of available shares and therefore increasing the value of the remaining shares. So, or the cost of debt needed to fund the business, or the ability of the company to fund acquisitions and so drive growth. A practical example of this would be a company that has made a commitment to grow its dividend by, say, 10%. If we can understand what level of financial loss would prevent the company paying an increased dividend, then we can assess the company's financial tolerance. Of course, that loss could arise from many reasons, not all of which are insurable. Exchange rate losses or increased commodity prices are examples. So we also need to consider how much of that tolerance number the company is prepared to allocate to insurance volatility. But once that's been agreed, then we know the company's appetite or willingness to support insurable losses, and we can start to measure the value of insurance in reducing any volatility that goes beyond this amount of appetite. And for risks that were within the company's appetite, we can also measure whether it is more efficient to fund this exposure internally or to use contingent capital in the form of insurance. So we should all talk the same language. With this approach, we can help companies to quantify the value of insurance in removing unwanted volatility and help insurance managers present this in the financial terms that are relevant to the board, rather than the technical insurance jargon that makes it hard for the board to relate insurance to the business objectives and drivers that matter most to them. We believe that this approach allows you to move the insurance discussion from one that is price-driven to one that is value-driven. Of course, achieving this requires a different approach, one that, in addition to assessing the company's ability and willingness to retain risk, also places greater emphasis on data and modelling the impact and likelihood of key risks, and using claims data to profile the areas where a company may be exposed to potential volatility, so that the value of retaining or transferring this potential volatility can be measured.
So thank you very much for listening, ladies and gentlemen. Please do contact us for any further information here at JLT or Kinley at Airmic. Thank you very much indeed.